Hello and welcome to another episode of PS Perspectives. I'm Sam Nussbaum and I'm joined by my colleague Phil Gioia. Welcome, Phil.
Thank you, Sam.
And we thought for this episode we'd talk through one of the more traditional sectors of fixed income, agency mortgage-backed securities. It's a sector that has some headwinds this year in terms of fundamental and technical drivers, along with a changing relative valuation landscape for the sector. So Phil, can you kick us off and talk about spread movements within agency mortgages so far this year?
Yeah, certainly, Sam. So we've seen a lot of volatility in terms of agency mortgage spreads over the past, call it 18 months or so. So on the screen now, we're looking at the current coupon spread for Agency MBS, which is essentially the spread over Treasuries that you receive for a par price security. And what you notice on the screen is you have the blue line, which is the spread. You have the dashed line, which is the mean or the average going back to 2009. So really looking at the post-global financial crisis. And then the other horizontal lines they represent the standard deviations away from the mean. So going back to 2021, agency mortgages were essentially 2 sigma rich relative to their average going back to 2009. Fast forward about 18 months, and that relationship is almost the mirror opposite, right? Where we're now 2 standard deviations cheap relative to the mean. So really what's drove spreads to widen such a significant degree has been 2 factors. It's been Agency MBS technical specific, and then it's been broader interest rate volatility. So let's start with the technicals. And really this has been a combination of the Fed unwinding its balance sheet, as well as supply that has come into the market from Silicon Valley Bank and from Signature Bank. So those 2 banks were taken into receivership by the FDIC, and those assets are now being sold into the marketplace. It represents roughly $100 billion of additional supply that needs to be absorbed. But the good news is that the pace of sales has far exceeded the initial expectations. Initially, the pace of sales or the completion would take about 7 to 10 months. But what we've seen so far through just a month and a half is that roughly 50% of the pass-throughs have been sold, and about 35% of the total portfolio has been sold. So we think that these sales could be completed over the coming months, and that would help that headwind from the FDIC sales to dissipate. The other factor that has driven mortgage spreads wider has been broader interest rate volatility. So agency mortgages have historically been correlated to interest rate volatility. And on the screen now, we're taking a look at the Agency MBS current coupon spread. That is the blue line. And the gray line is swaption volatility. And swaption volatility is really just another way to measure interest rate volatility. And what you can see is going back to the start of last year, right, when the Fed started raising interest rates, that gray line, right, the swaption volatility or interest rate volatility started to increase. And as such, we also had agency mortgage spreads start to widen, right? That's to be expected given this relationship. And that held through much of 2022 and through at least the first part of 2023. But then you notice the divergence that took place really right around the time of the FDIC announcement, where agency spreads continued to move wider, but interest rate volatility became more subdued. So we think going forward, this relationship will normalize, particularly as the headwind from the FDIC sales winds down.
Right. So you talked about what's moved spreads wider in terms of agency mortgages so far this year. Where does that leave us in terms of the relative valuation picture relative to other sectors of fixed income?
Yeah, so broadly speaking, agency mortgages, their spreads aren't the only spreads that have widened, but they've certainly widened to a greater degree relative to other asset classes. So what we're looking at on the screen now is spreads for various fixed income asset classes. And the horizontal axis is the spread as of May 31st. And the vertical axis is the percentile rank of that spread going back to 2012, right? So really 10 years of data. And what you can see is that agency mortgages not only offer a wider spread than some other areas of fixed income, but on a percentile basis, they rank the highest, meaning that spreads have rarely been wider than they are today relative to the past 10 years. So attractive relative value both compared to other fixed income asset classes and also relative to its own history.
And spreads are only one component of what we look at in terms of relative value. You also need to measure the risk to return profile of any given sector. So how does that look in terms of agency mortgages today?
Yeah, so with agency mortgages, as agency mortgage investors, you're not taking on credit risk, right? Because these assets are backed by the government, but you are taking on prepayment risk. And one way that we measure prepayment risk is through convexity. Now, typically, borrowers in the agency mortgage pools, they have the option to prepay their mortgage. But what we've seen is that given that most homeowners were able to purchase homes in 2020 or 2021, or borrowers that were already in homes were able to refinance at much lower rates, that risk of prepayment has really dissipated in the current market today. The other factor that affects convexity is the dollar price. And given that we've had a very sharp move higher in rates, we've seen discounted dollar prices across the agency mortgage market. So these two factors combined have led to a much more attractive convexity profile. And on the screen now, the blue line is the convexity of the mortgage index, and the dashed line is the average convexity going back to 1999. So really 25 years of data, pretty long time period. And what you can see is that agency MBS have historically been negatively convex. But given those two dynamics we talked about, right, slower expected prepayments and lower dollar prices, today we're sitting at essentially a neutral convex profile, which implies a better return per unit of risk going forward.
Yeah. And investors typically use sectors such as agency mortgages in a portfolio of fixed income for their risk offsetting nature, right? So how do we expect agency mortgages to perform should market volatility pick up?
Yeah, so we really haven't seen any equity market volatility for the first 6 months of this year, right? The S&P is up over 10%, the NASDAQ is up close to 30%. But should we see equity market volatility come in the second half of the year, we do think agency mortgages could resume their more traditional role of being that risk-off hedge in portfolios. So what we're looking at on the screen now is the performance of various fixed income asset classes during periods of equity market drawdowns as measured by the S&P 500. So from the S&P 0 to -5%, -5 to -10%, so on and so forth. And over each of those time periods, we've seen agency mortgages historically deliver positive returns. This is data going back to 1992, so again, a very long data set or very long time period. But agency mortgages have delivered positive returns, again, over each of those market drawdowns and have outperformed investment-grade corporate bonds anywhere from 30 basis points to 600 basis points, depending on the drawdown, and have outperformed high-yield corporate bonds, which are actually negative during those periods of equity drawdowns, particularly because of the correlation to equities. So given that agency MBS has a low correlation to equities, we do think that they could be strong relative performers if we do see some equity market volatility in the second half of this year.
Yeah. So strong downside protection, attractive valuations. As I mentioned, agency mortgages are a sector that we use across a number of different portfolios here at DoubleLine. Mm-hmm. So how have those two factors figured into how we've moved allocations to the sector this year?
Yeah, so you heard Jeffrey Gundlach mention on a recent webcast that the agency mortgage market, it represents one of the most attractive entry points that he has seen in his career. And he's been investing in mortgages for over 30 years now. So because of the reasons we discussed today, right, kind of where spreads are, the relative value, the convexity profile, our team has been actively increasing our exposure to agency MBS across portfolios, depending on the risk profile. And we do believe that there is a significant alpha opportunity in actively managing and increasing exposure to agency MBS.
Great. Well, thanks, Phil, for walking us through the backdrop for agency mortgage-backed securities. Appreciate it.
Of course.
For more insights such as this, including a recently published paper by our agency mortgage-backed securities team, please go to our website at doubleline.com. Thanks for watching.